Hello, and welcome to the next lesson on Finance RM. This will be about assets and liabilities. So, firstly, we have assets. Assets are things that you own and that have economic value and can provide future benefits that can be sold, used, or leveraged to generate income. Assets increase your net worth. The types of assets include current assets, which are short-term, convertible to cash within a year, cash and cash equivalents, bank balances, accounts receivable, which is money owned by you, and inventory, which is the stocks or goods for sale, as well as prepaid expenses. Then there's the non-current, which is the fixed assets, which is more long-term, which has property like land and buildings, equipment and machinery, vehicles, furniture, and long-term investments, as well as intangible assets like patents, copyrights, trademarks, brand value, and goodwill. The financial assets include stocks, bonds, mutual funds, retirement accounts like pensions and IRAs. Characteristics of assets are that they add value to a business or individual as they help to generate income or provide utility essential for understanding financial strength included on the left side of a balance sheet. As well as that, assets have more detailed parts such as personal assets, such as emergency funds, houses or property, jewelry, vehicles, retirement savings, and side businesses and passive income. Business assets such as cash, office buildings and factories, accounts receivable, which is money owned by clients, inventory for resale, software and licenses, investments in other companies, company brand value or customer base, which is intangible. Asset information is that they can be liquid and illiquid, which means that they can both be converted to cash easily, whilst it can be converted to cash in a quite a hard way, as it can easily be converted like your savings, whilst it's illiquid when it's something such as real estate. Assets can appreciate or depreciate over time. As an appreciating asset, the value of it will go up over time, while the depreciating asset will have its value go down, for example, cars. Next, we have liabilities. Liabilities are things that you owe, your debts or obligations to others. They represent money going out in the future, as liabilities decrease your net worth. Types of liabilities include current liabilities, which are due within a year, such as credit card debt, accounts payable, such as bills or suppliers, short-term loans, taxes, and wages. Long-term liabilities include things such as mortgages, car loans, student loans, bonds, and lease obligations. Contingent liabilities, which are potential liabilities that depend on future events, such as lawsuits and product warranties. The characteristics of them represent financial obligations as they appear on the right side of a balance sheet and can be secured, which is backed by collateral, or unsecured. Too many liabilities can indicate financial risk. As well as that, there's again personal liabilities, which is mortgage, credit card debt, auto loans, personal loans, medical bills, buy now, pay later purchases, and utility bills. Business liabilities include supplier payments, payroll obligations, tax liabilities, loans for expansion or equipment, lease agreements, customer deposits until services are delivered, and litigation risk or legal liabilities. The final parts of liabilities is that they are fixed or variable, which the fixed ones, which are regular and predictable, are things such as loans, whilst variable, which can change by month, include things such as utilities or credit cards. Real life scenarios of them and how to get rich. Real life scenarios and examples is, for example, if you bought a house, the asset is the house's market value, while the liability is the mortgage you owe. The difference is your equity, which is a part of your net worth. Another example would be buying a phone. If fully paid, it's an asset even if it's depreciating in value, whilst it's bought on installment, it's still an asset but with a liability attached. And a last example, a business owner. Let's say someone buys a van for $30,000 as an asset. They take a $20,000 loan, so the asset is $30,000 and the liability is $20,000. So the net gain in equity is $10,000. How to track them? For example, entries like cash, savings, and objects, whilst liabilities include car loans, student loans, and credit cards. Your net worth is your total assets take away your total liabilities. You should try to increase your assets and reduce your liabilities and build a positive net flow. Try saving more, invest in appreciating assets, create additional income streams, and reduce your liabilities by paying off high interest debt first. Avoid new unnecessary loans and budget to reduce spending. And ensure your income covers expenses and allows for savings. Tips for management. Well, firstly, it helps overall, these tips in budgeting, financial planning, and investing. It's critical for getting loans or credit, and it's used by businesses to get assets, profitability, and growth. Influences credit score and financial independence, and the main tips are increase your assets by saving, investing, and building more resources. Limit your liabilities by avoiding high interest debt and repay loans on time, and review regularly by tracking your balance sheet, your personal or business. Focus on appreciating assets such as real estate and investments, and avoid depreciating liabilities like unnecessary consumer loans. Finally, we have a recap. Assets generate income. Liabilities use up money. Have more assets than liabilities, and track your expenses. Increase your net worth over time, and always remember that have more assets and their value, because the key difference is that assets will add value, liabilities will subtract. The positive net worth equals a good financial health, whilst a negative net worth equals bad financial risk. Your goal is to grow your assets and reduce your liabilities and increase your net worth over time. Thank you, and remember to be smart, stay smart, and achieve your financial goals. And don't forget to drop a like and subscribe to the video.